IAS 41 is one of a few sectoral standards out there because it applies mostly in agriculture, but not only there. And we should focus more on agricultural activity that can be performed also by other than agricultural companies. So let's dive in and learn a bit more about it. I am Sylvia of CPD Box, the website to be if you want to learn IFRS from scratch and get to the very advanced level, get your CPD certificates. And if you're stuck, then we can help with the advice. So check out cpdbox.com. So let's dive in the standard. Many countries have a huge agricultural sector because we all need to eat to survive. China, India, US, Germany, these are only few examples of countries with significant agricultural production. And the problem was that the accounting treatment of agricultural activities was not comparable between individual countries, and also agriculture relates to living organisms. So how should we reflect growth and reproduction in the financial statements, just as an example? And many similar problems arose, and to solve these issues, the standard IAS 41 agriculture was issued in the late 2000s, and it's applicable for the period starting on or after 1st January 2003, so it's here for some while. So what does it do? First of all, it defines a few terms related to agriculture to make absolutely clear what agriculture is and what it is not, and so where you should apply this standard and where you should not. For example, someone might say that if you have a guard dog to protect your property, you should apply IAS 41 because dog is a living animal. But guarding is not agriculture activity as defined in IAS 41, so you apply IAS 16 to accounting for that particular dog, despite the fact that it is alive. I added the link to an article explaining more about it in the description below this video, so please check that out. So IAS 41 defines terms like agricultural activity, including its main important elements, but we will not go into many details here. Then biological asset, which is a living animal or plant. And here the common misunderstanding is that also the produce like apples or milk are biological assets. No, they are not. And also, even if you have a biological asset, you apply IAS 41 only if you are using it in an agricultural activity. So that's not automatic. Another term is agricultural produce, and this is the harvested product of entities' biological assets. So there you have your apples or milk. Another term, harvest, that's the moment when you get the produce from the biological asset, for example, milk the cow. So IAS 41 defines all these terms, and then when we know what these items are, IAS 41 sets the rules of how to account for them. More specifically, it deals separately with biological assets involved in the agricultural activity. So if you have some biological asset, some animal not involved in agricultural activity, but you have it for some other purpose, then do not apply IAS 41. Then, except for bearer plants, of course. Then agricultural produce at the point of harvest, and that's important. And the third area arranged by IAS 41 are government grants related to agricultural activity. IAS 41 does not apply to agricultural land, that's IAS 16 property, plant and equipment, or IAS 40 investment property, to intangible assets related to agricultural activity, and that's IAS 38, and to bearer plants, and that's IAS 16, and of course government grants related to these bearer plants, that's IAS 20. So let's firstly focus on biological assets. We have already learned that the biological assets are living animal or plants, and the main characteristics of these assets is their biological transformation or the change in their quality or quantity caused by some biological processes with the help of some natural resources like soil, sunlight, water, or air. So for example, when a little chick becomes a hen, right? So IAS 41 then further explains the types of biological transformation. And please bear in mind that the biological transformation is absolutely critical to the flow of economic benefits. Without biological transformation, there is no agricultural production system and no IAS 41 applies. And based on what role a biological asset plays in the agricultural system, they are categorized into two categories: consumable, and these assets, either plants or animals, are themselves harvested, for example, carrots or chicken. Another category is bearer, and these assets bear produce for harvest, for example, coconut palm tree. And before we explain how to account for both types, let's see when to recognize biological assets in the financial statements. And there are 3 recognition criteria, very similar as with any other assets. The entity must control the asset as a result of past event. And here the proof of control would be formal ownership records like legal title or branding. The second criterion is that it is probable that future economic benefits associated with the asset will flow to the entity. Well, biological assets have certain physical attributes that can be measured, and these indicate the future economic benefits. And the third condition is that either the fair value or cost can be reliably measured. So let's firstly explain the accounting for bearer plants. Careful, you can have also bearer animals, but we are focusing on bearer plants now, no bearer animals. Bearer plants are those that are used solely to grow produce over several periods, for example, apple trees or grape vines, and also they are not consumed, and when they are no longer productive, they are scrapped. How should we measure bearer plants? Well, there are debates all around the place about them because the fair value is not appropriate in this case. And the reason is that bearer plants are similar to machines in manufacturing activity. And also it was almost impossible to determine fair values of these plants in many cases. And therefore in 2014, bearer plants were excluded from the scope of IAS 41. That means you should apply IAS 16, property, plant and equipment. So what does that mean in practice? Let's draw the lifetime of a coconut tree as an example, and we can divide it into 2 parts. The time when the tree is growing until it is mature, and the time when it is mature and produces coconuts. Until it is mature to produce, it is measured at cost. And after it matures and starts to produce, then we need to start charging the depreciation and impairment losses if there are any. Careful about coconuts. They are the agricultural produce at the moment when you pick them up from the tree, and we will learn measuring them later on. Now let's talk about measurement of biological assets that are not bearer plants, for example cows or sheep. The basic measurement rule is to measure biological assets at fair value less cost to sell initially and at each reporting date. The standard says that the primary indicator of fair value is the net market value in this case, and you should be looking at the principal market as arranged by IFRS 13. So for the explanation of principal market, please take a look at our video on IFRS 13. If for some reason the fair value is not available because market prices or values are not available, then on initial recognition, the biological assets can be measured at cost, less accumulated depreciation, less impairment losses, if any. And this applies only for non-current biological assets because the current biological asset would be gone from the statement of financial position within 1 year. And it is applicable only on initial recognition until the fair value is available again. Then at the end of each reporting period, you should calculate the difference between the carrying amount at the end of the reporting period and the carrying amount at the beginning of the period. So this would be the change in the carrying amount, and you should recognize it as income or expense in the profit or loss for the period. This total change can be split into 2 elements. First element is a change attributable to differences in fair value, so that's affected by the market. And the second element is change attributable to physical change in biological assets. So for example, how much it grew. You should present these two components separately in the financial statements. Notes would be sufficient, but if it's an asset within the production cycle below 1 year, like chicken, then this presentation would not be useful and it's not required. And then a standard sets a few rules for presentation of biological assets. They're definitely a separate class in the statement of financial position, and you need to bring in more disclosure in the notes. That was the accounting for biological assets. Let's take a look at agricultural produce. The harvested product of entities' biological assets, for example, fruits, vegetables, milk, that's all agricultural produce. And this should be recognized at the point of harvest or when the produce is detached from the biological asset. So the apple picked from the tree, the milk milked from the cow, so you get the point. The produce is derecognized when it enters either trading activities or production processes without integrated agribusiness, for example, when farmers start to process milk and make cheese. When the produce is derecognized, then you start to recognize it under IAS2 inventory. So you stop having agricultural produce and you start having inventories. The agricultural produce is measured at fair value less cost to sell, similarly as biological assets, and the change in fair value is recognized as an income or expense in profit or loss. The agricultural produce is usually included within inventories in the statement of financial position, but you should disclose it separately, either in the face of the statement of financial position or in the notes. So as you can see, the guidance related to agricultural produce is easier, simpler than for biological assets, and it's because the produce is usually used in the shorter production cycle. The last topic covered by IAS 41 is government grants related to agriculture. So if biological asset is measured at fair value less cost to sell, which will be in most cases, then you can have two types of grants. Conditional grants, and these are provided after meeting certain conditions. Here you also need to include so-called set-aside grants or grants for not producing. For example, European Union regularly provides subsidies and grants to farmers in order to limit their production. Under IAS 41, you should recognize these grants as income when the conditions are met. The second type is unconditional grant, that is with no strings attached, and here you recognize such a grant as an income when the grant becomes receivable. So this is the treatment of grants when they relate to biological assets at fair value less cost to sell. But if you measure biological assets at cost less accumulated depreciation and impairment losses, and this is an exception when the fair value is not available, then you need to apply IAS 20, accounting for government grants and disclosure of government assistance. So that's it for the short summary of the main rules in IAS 41 agriculture. And in the description you can find links to more resources and articles related to this topic. Please like the video if you learned something new, share it with your friends, and visit cpdbox.com for more IFRS related learning. Thank you. Bye.